Welcome to part 2 of the Financial and Economic Warning and Opportunity. So, what Bob Proctor's saying is, if we're using Elliott wave theory, then the price of commodities is going to go absolutely to the moon. Why? Because the waves get bigger and bigger all the time. So there is some disparity in his analysis between Elliott wave predictions 2020 to 2023 and the cycle information. And the implication of that is, are we looking at runaway inflation or deflation, which is declining prices? Because if the Elliott wave period ended in April 2020, then we're looking at one scenario, and if we're using cycles, then we're looking at a bottom of 2022. So how does Bob Proctor reconcile this information? Because it leads us to a conclusion of, what are we looking at? It's either hyperinflation or it's hyperdeflation, major stock market crash. If Elliott wave predictions ended in April 2020 and if the cycles lead to 2023. Either way, the key point is the 2020 low. And what Bob Proctor says is that if that's broken, then the system goes into a deflationary black hole. What does that mean? An enormous crash in prices, leading to a liquidity crisis, and that means absolutely everything plummets in value due to debt. And in that scenario, even gold and commodities may fall. But here's something else he points out, which he calls an interest rate black hole, because there's a 78-year interest rate cycle as well. So again, the figures go back to 1942, with the spike for the US 10-year Treasury note at 15.84% in 1981, and then a decline all the way. The fact is, it really can't go much lower than the figure that applied in 2020, which was 0.51%. But the interesting thing here is we've got a 39-year rise and a 39-year decline. And his conclusion is, this is going up no matter what, whether there is inflation, whether there are defaults, whatever. The interest rates are at an absolute bottom and they're going up soon. So Bob Proctor's conclusion is, and this is a world-class forecaster who's been very, very accurate, is that there is absolutely epic economic and political change due this year, 2021, and there's not much of it left, because so many of these charts, so much of this data is aligning for this being a turning point. September, October and November especially of 2021. Here's some more information. This is Citibank's total of loans versus deposits. And what we're seeing is the deposits in red and the loans in green. What we're seeing is that these figures, the deposits that people put in the bank and the money loaned out, was more or less the same until 2007, 2008. And then they decoupled. So the deposits increased, but guess what? The bank loans have never got back to the rate that they were in 2007 and 2008. They've stayed more or less stable. So there's a glaring gap between loans and deposits. This is very significant. And it's not just Citibank, because here's JPMorgan's loans versus deposits. Look, the deposits are going through the roof in 2020 and 2021. But the loans? No. They're more or less at the same rate as they were in 2008. Here's Wells Fargo's figures as well. You see a huge spike in both in 2008. And look what's happening now. The total loans are actually going down while the deposits are increasing. What does this do in practical terms? It pulls money out of the economy. Why is this a problem? Here's the JPMorgan loan to deposit ratio. It's plunging through the floor. What it means is that deposits are more than 200% of loans for the first time ever. This is significant because loans from banks create the most new currency. And if new currency isn't being created, the economy itself is being strangled. And that's because banks can't make money from loans at the moment. What are they doing with it? They're putting it elsewhere. They're buying property. They're putting it on the stock market. But they're not creating loans. So the real economy is dying while the markets are being pumped. And at the same time, money supply has grown exponentially. Look at this from Shadow Stats. Top left, M3 money supply. Top right, M2 money supply. Bottom left, M1 money supply. So the money supply has shot up, absolutely shot up, but the loans haven't. The real economy hasn't got it. Where is it going? The stock market, housing. So what we're seeing is the result is that the velocity of the money supply is falling through the floor. This is very serious. It means that the money is not flowing through the economy. And here's Bank of America's total loans and deposits. Zero loan growth for 12 years now. Why is this significant? Because the last time this happened was just before the Lehman crisis. And we've got Wells Fargo telling its customers it's closing down all personal lines of credit. No longer offering credit to people. That's called revolving credit, letting people borrow $3,000 to $100,000. All that credit is being sucked out of the economy. The people who had credit have to pay it back. This is the start of a new trend. So here's the summary of the big four banks' total loans and deposits. It's historic. So why would they do this? It's because corporate America lacks faith in the Federal Reserve to control inflation as prices peak. So what happened in the 2007-2008 global financial crisis? The financial system itself locked up. Why? There was no credit. There were no funds or loans of lines of credit for anyone. What's happening at the moment? No funds, no loans, no lines of credit for anyone. And that debt represents new money flowing into the economy. So new loans dried up. They were down 80% from the peak. And the fact is that when banks see trouble, they stop doing loans. So what do you think the banks are seeing at the moment? Trouble. And then we had the central bank response, which was to make more debt and more currency to lower the interest rates and cheap money. It's life support for the economy. But it's gone. Not to the economy, but to the stock market. So in the meantime, we have the Federal Reserve balance sheet in billions. And this is January 2000 to April 2020. Do you see a trend change there in 2020? This is the repo market. So what's the repo market? The repo market is where banks lend each other money short term overnight to finance their operations. And it's absolutely shot through the roof. This is very significant because the repo market imploded in September 2019. Bank-to-bank overnight lending stopped effectively. And the banks don't want to lend because this is against surefire US Treasuries, which are used as security. So that should be absolutely better than gold as far as the banks are concerned. So this is like a banking pawn shop. And the fact is, no one wants to lend. It's a very serious sign when the banks don't want to lend to each other against US Treasuries. So the overnight's fund rate rocketed overnight in September 2019, literally in one night, from 2.3% to 10%. And the fact is, if there's no credit, there's no loans. So the result from September 2019 has been that the Federal Reserve injected liquidity. As a temporary measure, of course, only designed to be for a few days. And it started off at $75 billion a day. And by March 2020, it was $1 trillion a day. This tells us that the crisis has already started, but it's being limited to certain sectors. So the conclusion is the banks don't want to lend, not even to each other and not even against US Treasuries, because it's too risky. The result is that the banks are sitting on large reserves and loans are reducing. So home equity loans were down 13% in the first quarter of 2021. And then we've got issues in the reverse repo market. This is like reverse quantitative easing. This is where the banks send reserves back to the Federal Reserve. So the Federal Reserve issue reserves to banks. They use that as collateral to create loans. But not in this situation. The banks are saying, no, thank you very much. We're sending that back to the Federal Reserve because we don't want the liabilities. They're reducing the liabilities and the bank exposure. Why is that important? Well, it wipes out months of quantitative easing. And what's that doing? It's reducing the money supply. Why is that important? That's risking another credit freeze like happened in 2007, 2008. And bearing in mind this presentation was written in July, that was a record of 485.3 billion in May. So the banks owe the dollars to the Federal Reserve. And the fact is, at the moment, they don't want the risk. So they give it back. And this creates a massive deflationary risk to the entire system. Because what it means in practice is that trillions of dollars are being sucked out of the system. Why? Because of fractional reserve banking. If the bank is sitting on $1 million worth of assets, then they can lend out many times that in loans to people. And then when the loans get repaid, they lend out more money based on the same collateral. And when those loans get repaid, they lend out more money. So when the base collateral, the base money, goes back to the Fed, it's sucking vast amounts of money out of the banking system. And if vast amounts of money are being sucked out of the system, that means it's not being loaned to businesses who will reinvest. It's not being loaned to people who will consume, who will buy cars, who will build houses, etc. So that's why this is a massive deflationary risk. And here's the chart of the overnight reverse repurchase agreements. So this is money being sent by the banks back to the Federal Reserve, going back to 2016, 2017. what do we see? A big changing trend. First of all, around 2018. A big blip in 2020, and then the skyrocket in 2021. This is an indicator of banks losing confidence in the system. And here's a measure of commercial industrial loans, because they did shoot up briefly with the government incentive schemes, the furloughs, etc. in 2020. And then what happened? Again, that represents enormous amounts of funds being sucked out of the system. Here are the key issues though. The whole system, the whole economy is completely reliant on quantitative easing, which is new loans being made by the central banks, and we've just seen how the banks are undermining that, and stimulus, which is the checks going to ordinary people in order for them to get by. Both of them are absolutely essential for the economy and the financial system to keep going at the moment. We can consider these as life support for the entire financial and economic system. But hang on a minute. Political gridlock can stop the stimulus in its tracks. And that's exactly what we've got happening at the moment in the US. And if there is no agreement to raise the debt ceiling, because the Republicans are against it and some Democrats are against it, then that means a default for the US. The US not being able to pay the interest on its bonds, etc. And that means effectively bankruptcy. So, testifying before Congress, Treasury Secretary Janet Yellen urged lawmakers to address the looming debt ceiling, saying as follows: defaulting on the national debt should be regarded as unthinkable. Failing to increase the debt limit would have absolutely catastrophic economic consequences. So when the loans dry up, and that's exactly what's happening at the moment, we're looking at a situation which could lead to deflation, asset prices falling, a crash, and we're also looking at inflation at the same time in three areas: asset prices, goods and services, and the US dollar versus other currencies and or gold. And as an example of this inflation, California house prices have doubled in 2 years. So this is why the Bank of America is warning of real hyperinflation. They always warn us, and this goes back to February 2021. And here's the real position on inflation. And what we should bear in mind is that if with only 7% inflation over 10 years, if you're a pensioner, for example, you lose half the buying power of your pension. And what are we seeing? Well, using the old calculations of the US government, the official calculations were already at about 13-14% inflation. And that figure is confirmed by the Chapwood Index in the United States. So in red, we're seeing the new official figures because they were changed in the 1980s. That's why the graphs diverge from that point. But the recalculated figures based on the old measurements are showing that skyrocket happening. So 7% means half your purchasing power is gone in 10 years. It's very insidious. But let's now have a look at the US inflation rate historical chart. So bear in mind the figures that we've just seen, the fudged figures versus the real figures. If the current figures are around about 13-14%, how do they weigh up historically? Well, going back for 100 years, what we see is that we're at rates of inflation we've only seen 3 times before in 100 years. During the First World War, 1916 to 1919, 1945, 46, and 1979. So this is showing you how significant those inflation figures are. And here's the bottom line. Banks will have no choice but to flood the country with $2.5 trillion in loans, or a third of the currently outstanding loans, just to catch up with the head start provided by the Fed, to close that gap. The fact is that financial issues and inflation move from one sector to another. So in 2005, Michael Burry, famous for The Big Short, when he made billions by selling out of the market at the peak, so predicting the crash, closed mortgage-backed credit default swaps with Deutsche Bank. In 2006, after years of increases, the house prices in the US peaked and delinquencies started to rise. In 2007, the stock markets in China and the US fall. And in 2007, the subprime lenders, New Century and Lehman Brothers filed for bankruptcy. 2007, Bear Stearns bailed out 2 hedge funds. Banks refused to do business with each other, and BNP blocked hedge fund withdrawals. Then there was a run on Northern Rock, etc. So what we're seeing is a chain of events happening over a series of years, where very suddenly lots of things start to happen at once. Things jump from one sector to another. And we've got Evergrande happening in China at the moment as well. When one of these dominoes drops in the interconnected global world that we're in, we don't know what the unexpected consequences will be elsewhere. So we've got other indicators. These are contrarian indicators. The fear of missing out has infected retail and hedge funds alike as they ramp up exposure, which is risk, to chase performance. And we've previously discussed the near mania of retail investors taking on exceptional risk in various manners, from increasing leverage, engaging in speculative options trading and taking out personal loans to invest. It's all evidence of overconfident investors. But the fact is, in the last year, $1 trillion has gone into the US stock market, and that's more than the last 20 years combined. This also tells us we're very close to the top of the market. And when you've got such an epic bubble, they burst violently. Now the fact is, what's the dumb money doing? Well, the dumb money is the hedge funds, because they've always been major losers. They always pile in too late, in too risky a way, using leverage, and guess what? Look at this. They're absolutely piling into the stock market. That also tells us we're late in the game. That's another warning indicator. Here's another one. The headline is "The meme stock rally hurt Melvin and Maple Lane, and it hasn't gotten easier since." Hedge funds walloped by the meteoric rise of stocks such as GameStop and AMC Entertainment in January are still struggling to get out from under those losses. Melvin Capital Management, which lost more than $6 billion in January, is now down 46% for the year through June. And Maple Line Capital is down 39% for the period. This is the hedge funds. So as a reminder, this is the size of the global financial system. This is gold and Bitcoin. Here are the altcoins and silver. When the money runs to safety due to a crash in the global financial system, it will run into gold and Bitcoin, and even more into silver and altcoins. And here's more news on the economic side of things. Economy is the real world, not finance. Floods close rail lines in Europe for months or longer. That impacts cost, it impacts distribution. Bond yields are puking again. So when bond prices go up, the yields go down. Bonds are historically overvalued. They're the biggest bubble in the world at the moment. And while everyone looks at the stock market, the biggest market is bonds. The more important market is bonds. Why? Because companies sell their shares to invest, but they sell bonds, which are debt instruments, more than they sell shares. And the first call on the money of a corporation is on the bond market. So when a company has a problem, the bond price collapses. So Evergrande's bond price has collapsed down from 100% to about 30%. Why is this important? Because the smart money, if it thinks that the Chinese Central Communist Party is going to bail them out, then they'll be buying the Evergrande bonds, not in the hope that they'll go back from 30% to 100%, but maybe in the hope that they will go from 30% to 40%. If that's the case, then those companies can very quickly make a 33% gain on that distressed asset. But the bonds will always be repaid first. And the fact is, if they can't afford to repay them, then the shares go to zero. Bonds are therefore treated as a safety play. They're the priority. They're like the number one share option. So we have precursors. These are early warnings. The early warnings include the overnight repo market. 2019, the liquidity freeze, banks refusing to lend to each other, very quickly locking up the whole market, leading to that massive interest rate spike, going up fourfold from about 2.5% to 10% in one night. Then we've got that temporary support for the market, going from 75 billion a day, just for a few days, now at over 1 trillion by March 2020. Then we've got the issues in the reverse repo market, banks sucking liquidity out of the system, refusing to lend to customers, calling in credit and repaying their obligations to the Federal Reserve. Bank lending, in the meantime, going down. That means that the mom and pop businesses can't borrow money. We've got the information from Bob Prechter, the cycles indicating a massive top in the market in 2021 and a steep crash. And it's got to be a steep crash, and it's got to be a very short crash if the bottom is going to be in 2022. And then his evidence saying that that is when the commodities will bottom out as well, within a year of 2022. And we've got the technical analysis also indicating a massive stock market top and leverage. And if the leverage goes, the borrowed money means that people need to repay, they need to liquidate their assets, they need to sell, they need to move to cash. That's exactly what happens with bonds, and they're crashing through the moving averages. And on top of this, we've got the political issues of the debt ceiling and the fact that that's not a shoe-in anymore, and the fact that the economy relies both on QE, which they're talking about tapering, or they're talking about tapering, but that's like a puppet in the corner because the money's being sucked out of the system by the reverse repo market, by the bank lending. But if the debt ceiling doesn't go through, then that also means the stimulus checks don't go through either. So we've got money surging out of the markets at the moment. But people don't see it because they're looking at the Federal Reserve.